Well, markets are seemingly mid-correction. For the Australian market, another day like today, and we'll be there. So hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 18th of November 2025, and before I start, you do need to be aware that whatever I say is general advice only. Massive selling has been seen in most Western markets, in the US, but particularly in the Australian market. At the lows of today, we're, I think around 200 points off a 10% fall from our peak. So we've fallen about 7 to 8% from our peak just about 3 weeks ago. Really, it has been a really rapid pace and pretty broad-based selling. Now, in terms of what could be sort of dragging that or causing that, we'll touch on that in a minute. But what has been surprising is just the pace of the selling. The market seemed so happy to buy things up just a month ago, and yet, a switch has turned, a switch has been flipped, and those rapid buyers have very quickly turned into rapid sellers. I do want to touch on interest rates as being a big factor in that, and that's going to be the next slide. But I will also say that it shouldn't be too surprising that our market has fallen this quickly and this strongly. A lot of this selling does coincide with the reporting from our major banks. Now, these major banks have rallied very strongly for the past 3 years, and we've all been the beneficiaries of that. We've seen our super funds go up. Some of us have held these shares directly. But that rally was built on pretty much nothing, and we do have to acknowledge that. These bank earnings have barely budged for 3 years, and yet the share prices are up, in some cases, close to 100%. We've seen some of them haven't even lifted dividends in that time. It hasn't been particularly good earnings performance from these banks, and so as they reported, some of them saw a bit of selling, and that's sort of added to the woes of the Australian market. The other thing that has been causing some selling, both in Australia and overseas, has been a view that we might be coming to the end of this rate cutting cycle. So the RBA basically at the last meeting kept rates on hold. They said whether we cut again is going to depend on inflation, which they saw as coming back up, and the wider economy and the jobs market. After that meeting, we had a stronger than expected jobs report, and we've seen some pretty strong Australian inflation recently, and it basically looks like we might not see any more rate cuts this cycle. Now, we did see the RBA meeting minutes from their last meeting that were released today, and they did say that their central forecast was still for around 30 basis points or 0.3% of rate cuts in 2026. Now, that was way down from their estimation at the previous meeting. So already they're sort of starting to reduce rate cut expectations. But we also have to remember that those minutes came out before the better than expected jobs data. And so given they only saw one more rate cut next year, the fact that the data has come out against further rate cuts is basically saying to the market, maybe that is the end of the RBA rate cuts this cycle. So after the minutes came out, we did see our market continue to sell off, and we sold off all throughout the day up until about 3:30, where we saw dip buyers return a little bit. The US is in a similar position. Now, they are still expecting at least one more cut out of the Federal Reserve, either in December or perhaps January, and then maybe another one, maybe 2 rate cuts next year. However, their market is also starting to price in rate cuts drying up, and the fact that we may be at the very end of the rate cutting cycle. Rate cuts have been pretty much the big driver of global everything rally that we've seen for the past 2 years. It's one of the big 3 drivers, perhaps the most important. The other one, and either the second or equal most important, has been US government money printing, and that's staying in place. US government is going to continue to print money. In fact, they're going to increase the rate of money printing and debt accumulation that they're doing, and so that's still there. But the other side of things, the rate cuts, starting to dry up, and that is starting to cause some to question whether this great everything rally is going to continue. And finally, the third sort of lesser important factor of the great everything rally has been the AI bubble, I would say. Some people say it's not a bubble. Well, if not a bubble, why bubble shaped? it is definitely a bubble in my opinion. I don't want to go into that here, but there's certainly features of bubble-like behavior going on. Now, AI has been a less important, but still important factor in the global everything rally, because it's allowed analysts and forecasters and market talking heads who 99.9% of the time drive the market higher. It's allowed them to say that earnings are going to be great in a few years' time because of AI. AI is going to reduce expenses, it's going to increase revenues, and so AI is going to be earnings accretive for every business on earth. So it has been it has allowed the narrative to sort of develop that, yes, these companies are worth these prices, because in 5 years AI means that they're going to be paying, zero wage bill and earning infinite revenues and blah, blah, blah. So it's the lesser important factor, but it is still a somewhat important factor. Now, we will see the most important AI company on earth report earnings this week, and that's going to be tomorrow night from Nvidia. Nvidia makes the chips that power these AI language models. They run on graphics cards, basically, and their earnings report will basically determine whether or not, companies are continuing to fork out, as much money as they practically can into buying more and more and more chips. If this report is good, it might stymie some of the selling that we're seeing at the moment. So I would say that basically whether or not we see a correction comes down to the strength of Nvidia's report tomorrow night. If the report is good, basically I think it'll allow another leg up into the end of the year. Maybe we'll see fresh all-time highs. Maybe we'll see it back to the highs. Who knows? But particularly with another US rate cut expected, it could allow things to push back towards the highs, particularly in US markets, and that would probably drag us higher as well. However, if the report isn't that good, and it is going to come eventually, whether this report or the reports next year, if the report isn't that good, we will see markets correct, in my opinion. And possibly, that'll be the beginning of the end, or, perhaps we are already in the beginning of the end for the great everything bull rally for the past 2 years. All right, let's have a look at the charts for this week. We'll start with the US, just because it takes a lot longer to load if I was to start with the Australian market. They've been on a giant ascending channel, and overnight they actually dipped below the uptrend line, the lower bound of that ascending channel. They also broke below the sort of key support resistance line at 67.40, and they broke below the 50-day moving average. Their stochastic is pointing lower, and overall these technicals are looking quite negative. They're pointing to me to a fall back towards 65.50. That would be the previous trough. We also note that they did set a lower peak in last week's sort of upwards movement. So they have set a lower peak. We're now looking for potentially a lower trough or a hold of support around 65.50. So it broke several key levels overnight, and that would indicate technically a little bit further bearishness. All right, let's now look at the Australian XJO index, and that's the chart we can see here on screen. You can see just how strongly we've fallen off since our peak in October. And like I said, a lot of that began with some fairly negative bank reporting in sort of early November, and perhaps a bit of overextension from our move in October. Today we had a pretty monumental fall. We broke through several key levels of potential support, and we finished right around our low from the month of June. Now, I don't know if you recall, but that was basically when it looked like America was going to go to war with Iran. That was the last time we were at these lows. We also closed below our 200-day moving average, closed below the 8,500 level, closed below another potential level around 8,540. So it does look like we've sort of sold off pretty heavily, but we are still quite a way above a correction level, a 10% fall from our peak. Now, a 10% fall would indicate a move back towards about 82.50, and I do think that that's quite a likely scenario at some point. However, rarely do we see a correction happen in one fell swoop as we're seeing now. So I do think it's quite likely we'll see, a level of support found around the current levels, and then a bit of a bounce back before we, then set a lower peak. Overall, the Australian market is looking really quite negative, and it's looking a lot more negative than US markets, than European markets, than Asian markets. Our market is definitely overpriced, and perhaps more overpriced even than the US market, which is trading at historical valuations. So the severity, well, the selling shouldn't be surprising. I guess what is surprising is the speed and severity of it, the rapid pace of our current correction. So we'll wrap it up there for this week, guys. Hoping that we do see a little bit of a bounce in the short term. It does look like we've overextended relative to global markets. However, our market perhaps also overextended to the upside, so we might be witnessing a little bit of normalization going on. I will wrap it up there for this week, guys. Hopefully you enjoyed. If you did, click like, click subscribe, and we'll see you next time.